Exercise 21 15B involves a sales leaseback. If you'll recall from class discussion and reading in the textbook, a sales leaseback is where an owner of a property sells that property to another party and immediately leases back the use of the property. This is done for a couple of reasons. One, for tax reasons, and secondly, for financing purposes. It might allow the seller slash lessee of the property to get access to the cash value of the property while still continuing to use the property. So here's the facts of the problem. We're standing here today on January 1st, 2014. So we've got Intech. Intech is the seller lessee. They own the property, which is a computer system, and they sell that property to First Tech. First Tech is the buyer slash lessor of the property. So immediately after Intech sells the property to First Tech, they lease the property back. Hence, that's why we call Intech the seller, First Tech the buyer. The buyer in turn leases the property back to the seller, so the buyer becomes the lessor and the seller becomes the lessee. Now, the agreed upon sales price is $1.5 million, and then there's some additional information down here. First off, the computer was carried in Intech. Intech, again, is the seller lessee. It was carried in their books at a carrying amount of $900,000. So we know that Intech, since they sold it at $1.5 million, they have enjoyed a gain of what, $600,000 on the sale, because they sold the property at $600,000 more than it was carried on in their accounting records. We're told that the lease term, the period of time that Intech will lease the property back from First Tech, is 8 years. And we're told that at the end of the lease term, title will transfer to Intech. Okay, so the company who is leasing the property back, they own the property originally, then they sold it to First Tech. They're going to lease it back from First Tech for 8 year period of time, and at the end of the 8 year lease period, title to the property is going to transfer back to Intech. Let's see, the lease agreement requires equal rental payments of $261,022.09, so that's the amount of each of the lease payments. We're told that Intech the lessee's incremental borrowing rate is 10%. First Tech, in determining the amount of that they were going to charge in terms of rental payments, set the rate of return on the lease at 8%. So the lessor's implicit rate on this leasing arrangement is 8%. So here's the first problem that we've had, where we have both the incremental borrowing rate of the lessee as well as the implicit rate of the lessor, and the lessor's implicit rate is known to the lessee, and it's less than the lessee's incremental borrowing rate. So in this particular instance, in doing the present value calculations, the lessee, Intech, is going to use the 8% implicit rate of the lessor, because that rate is less than their own incremental borrowing rate of 10%, and they know what that lessor's implicit rate is. Okay, the computer has a fair value of $1.5 million and an estimated economic life of 8 years. So the lease term is going to span the same period of time as the economic life of the asset that's being leased. And we're told here that Intech pays executory cost of $15,000 per year. That $15,000, those $15,000 of executory cost are not included in the rental payment of $261,022.09. They don't explicitly tell you that, but you gotta kind of infer it. Okay, so what we're asked to do is to prepare the journal entries here for both the lessee and the lessor for 2014 to reflect the sales leaseback. And one final fact is, if this lease is tentatively considered to be a capital lease by the lessor, in addition to meeting one of the 4 tests, for this to be given capital lease accounting recognition by the lessor, there has to be, collectability of the rental payments has to be reasonably certain, and no significant uncertainties exist as to future costs to be incurred by the lessor. In other words, the lessor has done essentially all it is that they are supposed to do in order to, fulfill their requirement of the lease. So those are the basic facts. Okay. So first, let's take a look at the entry by the seller lessee. The seller lessee is Intech. So let's take a look at the entries in their accounting records. So on the day they enter into the lease agreement, 1/1/2014, the first thing that they have to do is they have to book the sale of the computer. They're going to book the sale of the computer. Now remember, they sold the computer for cash of $1.5 million. So they're going to debit cash for $1.5 million. Now that computer equipment, according to the facts of the problem, was carried in their accounting records at $900,000. So they're going to credit property, plant, and equipment dash computer for $900,000 in order to remove from their accounting records that computer that they just sold to First Tech leasing company. And then, as I mentioned earlier, the excess of the sales price over the carrying amount of the computer in the accounting records of Intech represents a gain on the sale of the computer equipment. But in this case, that gain is not going to be recognized at the time of the sale. Instead, that gain is going to be credited to a deferred profit on sales leaseback. It's going to be not going to be recognized. It's going to go to the balance sheet, liability section of the balance sheet as a deferred profit account. And the reason for that is that it is a sales leaseback transaction. In sales leaseback transactions, any gain experienced on the sale portion of the transaction is not immediately recognized by the selling entity, but rather is deferred. And it's going to be amortized over the lease term of the leaseback, as we'll see in just a second. Okay, so this is the entry that the seller lessee is going to make in order to book the sale of the equipment. Here's the entry that they're going to make on 1/1/2014 to book the lease back of the equipment. As usual, they're going to debit lease the equipment for the present value of minimum lease payments, and they're going to credit the lease liability account for the present value of minimum lease payments. In this case, the present value of the minimum lease payments is calculated by taking the payment amount of $261,022.09, that's simply a given in the facts of the problem, and multiply that payment amount times present value of an ordinary annuity factor, where I is equal to 8% and N is equal to the lease term of 8. Now remember, we have something sort of unusual here in that the discount rate that the lessee uses in this present value calculation is not their incremental borrowing rate. Their incremental borrowing rate, the facts of the problem tell us, is 10%. We're not going to use that rate though, because the lessor's implicit rate is known to the lessee, and it's less than the incremental borrowing rate of the lessee. So we're using the lessor's implicit rate of 8% here. So the appropriate present value factor is 5.74664. That multiplied times the payment amount of 261, I think I've got too many zeros there. That's supposed to be 261,022.09. I left out my decimal point. That's going to give you total present value minimum lease payments of $1.5 million. So the entry to book the capital lease here on the part of the lessee, seller lessee, debit leased equipment, credit lease liability for $1.5 million. Okay. Over the course of the year, as the lessee makes executory cost payments, payment of interest, payment of taxes, payment of insurance, that sort of thing, they're going to debit insurance expense, tax expense, etc. for $15,000 and credit cash. Or if the insurance is prepaid, of course they would debit prepaid insurance. Okay, at the end of the first year, at December 31st, 2014, the lessee is going to book depreciation expense on this leased asset. Debit depreciation expense, credit accumulated depreciation. The amount here is calculated by taking the amount at which they booked the equipment here in this journal entry, 1.5 million, subtracting from that guaranteed residual value. Well, there is no guaranteed residual value, so the depreciable base is just the 1.5 million, and divide that by the appropriate depreciation period. Now, as you'll recall, the appropriate depreciation period normally is the lease term unless there's either a bargain purchase option or title transfers to the lessee at the end of the lease term. In this case, title transfers at the end of the lease term, so the depreciation period is the economic life of the asset, not the lease term. However, in this particular case, the facts of the problem are worded such that the lease term and the economic life of the asset are the same. But the point I'm making here, I'm emphasizing, is that in principle, the period of time that we're depreciating the asset over should be the economic life of the asset, not the lease term, because title transfers to the lessor at the end of the lease term. Sorry, title transfers to the lessee at the end of the lease term. Moot point in this case, though. Okay, so the depreciation calculation, 1.5 million divided by 8 gives you $187,500 of depreciation expense to recognize. Okay, let me clear out a little space here so that we don't get lost as to where we're at, and then I'll continue with the journal entries. Okay, so now, next entry to make is we deferred profit on the sale of the property, on the sale of the computer equipment up here at the time of the sale. What we're going to do is we're going to amortize that $600,000 deferred profit over the lease term. Each year, we're going to recognize $75,000 of that deferred profit. And the entry we're going to make to recognize that $75,000 each year is debit the deferred profit on sales lease back account, $75,000. That's the account that we originally booked the deferred profit to. So we're transferring out of that account. And the offset to that entry is going to be a credit to depreciation expense. So essentially, this deferred profit here on the sale is going to serve to reduce the amount of depreciation expense that we're recognizing on this asset over the lease term. Okay, so then I believe the lessee has one more entry to make, which is they've got to book the lease payment. The lease payment here, let's see, when does the lease payment occur? Does it occur at the end of each year? Okay, so this is present value of ordinary annuity. Yeah, we already decided that. Okay, so at the end of 2014, December 31st, 2014, the lessee, the seller lessee Intech, is going to go out to their mailbox, open the mailbox, and they're going to find a check in the mail. I'm sorry. The lessee is going to write the check for $261,022.10, and they're going to drop it in the mail on December 31st, 2014. Credit cash for the amount of the required lease payment. They're going to debit interest expense for the portion of that payment that is deemed to be a payment for interest. And the way they're going to calculate that is they're going to take the carrying amount of the liability at the beginning of the interest period, which is $1.5 million, and multiply it times the discount rate that they're using in these present value calculations, which is 8%. 8% of 1.5 million gives you $120,000 of interest expense. The difference between the cash payment amount and the interest expense amount is the portion of that payment that is characterized as a principal payment, which serves to reduce the lease liability amount, and that's going to be debited to the lease liability account. So the total bottom line journal entry that the lessee is going to make on December 31st, 2014, when they cut the check to the lessor, is credit cash $261,022.10, debit interest expense $120,000, and debit the lease liability for the difference. Okay, so those are all the entries that are to be made by the lessee. Now let's take a look at the entries to be made by the buyer lessor. The buyer lessor is this First Tech here, First Tech Leasing. So First Tech Leasing bought, there's two things to book for First Tech Leasing on 1/1/2014. They need to book the acquisition of the computer. Well, they cut a check to the seller for $1.5 million, and they by cutting that check, they acquired the ownership of the computer. So the entries: debit property, plant, and equipment for the purchase price of $1.5 million, credit cash for $1.5 million. That's the entry to make by the buyer lessor to record the purchase of this equipment. Now the second thing that the buyer lessor needs to book on 1/1/2014 is they need to record the lease. Now for them, this is a direct financing lease because the fair market value of the asset that's being leased is $1.5 million, and the cost to them of the property that they're leasing is $1.5 million. So they're going to debit, this is a direct financing lease, so they're going to debit the lease receivable account for the present value of the minimum lease payments plus the present value of any unguaranteed residual value. There is no unguaranteed residual value, so they're simply going to debit the lease receivable account for the present value of the minimum lease payments. And the present value of the minimum lease payments for them is calculated by the same way it was up here by the lessee. You take the present value of an ordinary annuity factor, multiply it times the recurring rental payment amount, and the result is the present value of the minimum lease payment. So that turns out to be $1.5 million. So they're going to debit lease receivable for that $1.5 million. Again, zero residual value, unguaranteed residual value. And then they're going to remove the computer from their accounting records because they lease the equipment. So they're going to credit the property, plant, and equipment account $1.5 million. That's the entry they make to book the lease part of the transaction that took place on 1/1/2014. Then at the end of the year, December 31st, 2014, they're going to go out to the mailbox. They're going to find a check in the mailbox where the lessee wrote them a check for $216,022.10. They're going to debit cash, of course, to record the receipt of that cash. They're going to credit interest revenue to recognize the portion of that lease payment that represents interest. And the way they're going to calculate that is they're going to take the carrying amount of their receivable at the beginning of the year, which is $1.5 million, and multiply it times their implicit rate in the lease agreement of 8%, and the result of the calculation is $120,000. The difference between the cash that they receive and the portion of that payment that is characterized by interest is the portion that's characterized as a payment of principal, which serves to reduce the lease receivable account. So they're going to credit the lease receivable account for the difference of $141,022.10. So in this particular case, if you look at the payment that is made by the lessee to record the disbursement of the cash from the lease payment, it's the mirror image of the entry that is made down here by the lessor. Credit cash there, debit cash here. Debit lease liability here, credit lease receivable here. Debit interest expense here, credit interest revenue there.